Hi, morning everyone. Welcome to our weekly webinar at 11:15 a.m. Right. So for today's topic, we'll give an update on SingPost, and then will be followed by outlook on the property sector that will be covered by my colleague Caroline. So just to introduce, this is Colin, and I'll be giving an update on SingPost. Right. So just to check if anyone has any problems hearing me. Right. So if everything's okay, then we'll just go on with the webinar. Right. If you have any questions, do feel free to type out any questions that you may have during the webinar, and we will answer your questions at the end of today's webinar. Right. So just a quick update on SingPost, which has recently announced the acquisition of Courier Place from the New Zealand Post for 95 million Australian dollars. Right. So this approximately equals to 105 million Sing dollar. Right. Courier Place is mainly specialized in the small parcel delivery business in Australia, and with this acquisition, it will help add the last mile delivery capabilities to SingPost, right? So mainly, just to talk more on the acquisition, right? The purchase price is estimated to be in the range of 15 to 20 times PE on a normalized basis. This is shared by the management, right? And this will imply a 4 to 5.4% earnings contribution based on a FY14 data. On a pro forma basis, right? So mainly now with the acquisition, SingPost is now able to provide a complete end-to-end e-commerce logistics solution in Australia, as they already have freight forwarding capabilities with that's provided by subsidiary Famous Holding, as well as warehousing capabilities which is offered by Quantum Solutions, right? And the acquisition will also allow SingPost to tap on the growth in Australia's e-commerce market, which is in line with the group's strategies on expanding its logistic networks and as well as e-commerce strengths in Asia, right? So the just to take note that the weaker Australian dollar may provide further headwinds and may lead to earnings erosion from Courier Place. However, this at this time, the Australian dollar is actually trading at a historical low against the Sing dollar on a 4 years historical low, and actually provides an opportune moment for the acquisition, as well as any restructuring costs that may follow right after the acquisition for SingPost. So basically, we still overall we still maintain and accumulate recommendation in view of the potential upside from the current share price, as we are still very positive on SingPost having its strong growth prospects from the growth in e-commerce, as well as mainly from the region. Right. Right. Next, I will hand over to my colleague Caroline to talk on the property sector.
Thanks, Colin. Morning, everyone. This is Caroline. Today, I will actually do a recap, a summary of the performance on the residential outlook for the year and what we feel will be coming in the next, at least first half of next year. On the whole, the private residential price index has slid for the fourth consecutive quarter. In the third quarter, in last quarter, it has slid for the fourth consecutive quarter of 0.7% quarter to quarter, on which is on a is about 3.9% lower from the peak in the third quarter last year. The drop, the highest drop will be from the core central region, followed by the rest of the central region, and of course the smallest drop is from the outside of the central region. On the whole, we have seen that for the third quarter, there's a slower decline as compared to the second quarter. So we believe that the market is slowly adjusting to the price decline accordingly. Median price for the new launch landed was about 1.02 million, lower than the 1.09 million in 2013. This is mainly due to smaller unit size being sold. The median size has shrunk from 829 square feet in 2013 to 753 square feet in the 9 months this year. For the transaction volume, there has been slowing sales activities as the third quarter transaction volume actually falls about 30% quarter to quarter, which is the second lowest quarter since 2009. The primary sales plunged mainly due to the limited of new project release for sales. There has only been about 1,294 units launched versus the 2,843 units launched in the second quarter of 2014 and versus the 3,313 units in the quarter of 2013. This has been the lowest launches and the primary sales quarter since 2009. The biggest drop on the launches actually come from the outside of the central region with only 503 launches. As you can see, across the region, all the regions have lower sales launches with the suburban area being affected most. The 10-month transaction volume actually down 50% year-on-year for primary sales accordingly. As you can see in this graph, you can see that the launch and the sales units is actually lowest accordingly since the 2001-2. And the price changes from here. The drop is actually more drastic for this central core region here. On the whole, for the third quarter, we feel that it has been the fact that the developers are actually focusing on selling the old inventory to avoid penalties, and there's only about 780 units out of the sold units. About only 780 were new launches. For example, some of the old launches, they actually sold like they tried to push for the sales by selling at lower at, for example, like the Venmo at Kenya and also the Panorama accordingly. Top performing new launches for the third quarter are actually Citygate, Highline Residence, 70 St. Patrick's and Citron Residence, mainly due to their locations and the pricing of this place. For example, like the Highline Residence is launched in Tiong Bahru, which has not seen any new launches since the past few years. So this has actually generated a better influence accordingly. What we feel that for the fourth quarter, the sales volume will likely be higher with highly anticipated launches like the One Tower, Marina One Residence, Sophia Hills, TLE Residence accordingly. The Marina One has actually sold pretty well. They launched 400 units and sold about 334 units since then, mainly due to the developer actually gave about a 10% early bird promotion. So we feel that for the moving forward, the developers will likely boost up the marketing effort by giving early bird price discount or other promotion to push for the initial sales. We expect the primary sales for this year to be close at about 7,500 to 8,500 accordingly versus close to 15,000 sold last year. This is expected to drop about 50% year-on-year basis. Here are some of the details of the new launches with good sales and the major upcoming launches moving forward. For the supply side, the supply of the new private residential units stand at about close to about 80,000 within the next 5 years. Including EC, the supply will be close to 97,000. The unlodged and unsold units with prerequisite for sales still stands at about 22,000. We expected completion of about 4,000 plus units in this quarter and close to another 20,000 in 2015. And with that, we see that with the as you can see in this graph, there's upcoming supply of completion within the next 2 years, and this is why our National Development Minister Koguwan has announced that the government will actually reduce the supply for BTO and also fewer sites to be put on sales for the government land sales. Per last Friday, they actually has announced the new residential sites on the confirmed list, and for the residential site, it actually dropped about 23% as compared to the second half last year. So you can see even the government is scaling back on the supply for this in anticipation of the flood of supply completion within the next 2 years. For the rental market, the rents for the private residential homes continue to soften. It has dipped 0.8% quarter to quarter after a dip of 0.6 in second quarter 2014, as you can see in the graph here. Of course, as usual, the greatest dip comes from the central region accordingly. And this is actually the fourth consecutive quarters of decline already. The vacancy rates remain flat after in third quarter at 7.1% after 5 quarters of increases the first quarter in 1.3. We expect the rent to face downward pressure and the vacancy rate to increase with the anticipated streams of completion and the foreign labor restriction, which also shrink the tenant pool. For the for the resale market, the HDB resale index actually increased slightly in October. However, this trend is not like long lasting. It has again dropped about 0.8% month on month, and this is the lowest for the past 40 months, and the drop has been about 9.8% since peak in April 13. For the private residential index is up slightly in October, but as we anticipated the November results are not out yet, but we feel that it will exhibit the same pattern trend as the HDB resale, where it will also drop in the November accordingly. Main thing for the resale market is taking longer time to secure a deal. In the past, the condo take about 3 months or so, but now it will actually take on average 6 months to actually secure the deal. For HDB, it has also increased from 60 days to 91 days accordingly. This is mainly due to the buyers being more cautious due to the stricter financing and also waiting for better pricing, since they anticipated with the completion of new upcoming housing in the next 2 years. Is for the HDB median price spread, you can see this median price spread is actually the difference between the asking price and the transaction price. You can see that for the past 3 quarters, the spread actually increases, which means that buyers are not willing to actually pay that much, and sellers are still not lowering the price expectation. And with the mismatch, the transaction volumes has actually not improve accordingly. For the non-medium price spread, you can also see that for the non-private medium price spread is also increases accordingly as compared to 2013. We feel that the resale price will likely to edge lower in 2015 due to the oncoming flood of new homes with an increased number of second-timer, which is to the new BTO flats, which means that about 6,000 people per annum are actually getting new flats, and which means that they need to these 6,000 units will be also homeowners will need to sell their flats upon receiving the new flats then. So on the whole, for the property outlook, the market outlook continues to face headwinds with the cooling measures to stay in near term. Since 2009, the property price index has rose like 60%. However, the price for the new price for new units has been pretty resilient, with only a gradual fall of about 4% since the peak. The street financing and the regulatory environment will likely to continue to temper the demand for homes and weigh down the prices into 2015. We expect a total of about 10 to 15% correction by 2016 from peak then. For new sales volume, it will be expected to remain modest, with the cautious buyer adopting the wait-and-see approach for better pricings, and developer may further delay the launches while clearing the old inventory. Well-located projects with strong location attribute for attractive pricing points like near the new Thomson East Coast Line or new regional hub will likely see strong sales. For example, the late life EC has actually managed to achieve a take-up rate of close to 98% within 1 week from their launches then. So it shows that some places are still buyers are still interested in some places, and some projects, and these projects will draw strong sales, but likely for the rest, the sales will be more challenging to achieve. For the rental housing market rents, it remained depressed will likely to remain depressed for 2015, with many completions and slowing inflows of foreigners into Singapore. And government has scaled back the supply of private land housing by close to about 23% on the GLS program for the first half of 2015. For other market, let us take a look at other markets, other subsector. For office, it has been the top performance for this year, and we believe the trend to also continue into 2015. This demand is the rental increase is actually driven by the tight supply rather than the increased demand. So as mentioned, we feel that this will continue into 2015, but the rental growth momentum will likely ease into second half of next year, with the anticipated upcoming supply for Grade A office and CBD area in 2016, as you can see in the graph here. And we feel that for prime commercial asset rental, they should still remain resilient. However, older big Grade B offices will likely be affected. So when looking at this, the companies with good prime commercial assets should still be less affected accordingly with this trend. For the retail, we have a neutral outlook for this. The rental growth has been kept by the influx of the new suburban malls, as you can see over here, the development supply pipeline, and the falling footfall, which is down 1.5% year on year. Rising business costs, slowing retail sales from increased competition from e-commerce, and also the declining tourist arrival. Demand for the retail sales in prime shopping areas like Orchard Road should still be healthy because of the limited supply, and also international retailers are looking into Orchard area to launch their brand or expand their presence in the region. For hospitality, we have a neutral outlook. Mainly, this sector is facing headwinds with upcoming hotel supply in 2015 and 2016, and also the slowdown in the tourist arrival with less Chinese visitor and increasing operating environment. The luxury and hotel with strong corporate customer base should still remain resilient, which will be less affected because they are less affected by the decline in their China tourists. So on the whole, we believe that property developer stock price has taken into account the oversupply in the residential market, but there has yet to be any bullish catalyst for the sector yet. We prefer developers with a geographical diversified portfolio and a strong recurring income to weather the lumpy development sales cycle for this period. Low gearing of fixed rate debt to counter the potential interest rate increase, and also organic growth pipeline via AEIs or investment development, AEIs or by acquisition or development projects. For our coverage, we have a buy for Amara Holdings, as we have shared that for Amara, the Amara Bangkok will start commencement in the first quarter of next year, and also Amara Shanghai, which will be completed in 2016. With this two, it will actually double the revenue for the hospitality once the new completion is finished and is stabilized accordingly. And also for Amara Singapore, although just now we mentioned that for the outlook for tourism is neutral, but Amara Singapore has been able to perform well with its strong corporate customer base, and the revenue per room and the average occupancy rate has been achieving above the industry performance. And also for next year, we believe there will be the earnings higher revenue recognized from the JV project at City Life at Tampines, which the TOP is expected to be brought forward to the end of next year. So with that, we have a buy at target price of 0.70. For Hobby, we like Hobby for its geographical diversified portfolio. For next year, the income will likely come from the recurring income from Metropolis and the expanding London portfolio. Development income from overseas will only boost the earnings in the financial year 2016. We have accumulate rating for this at a target price of 2.33. For OUE recently has proposed divestment of the OUE Crown Plaza Changi Airport for about 495 million in two phases to unlock the capitals. We expect, based on the past performance, we expect OUE to also will also give special dividend in terms either of cash or maybe possible shares for OUE C Trust, as what they have done previously for OUE H Trust. For other AEI activities, it includes the OUE downtown retail mall and the service apartment, which will be completed in FY 2016. The US Bank Tower observation deck, which also will be completed in 2016, and the JV Korean project for hotel developments expected to be completed only in 2018. For this, we feel that the price movement for OUE may be subdued for now, but we still feel that it is a good buy, and we have an accumulate rating at target price 2.52. Next two is actually they don't have much they don't have much portfolio in Singapore, but for GLP, we like the GLP for its market leader position as a logistic property player in China, Japan, and Brazil. The outlook for GLP is driven mainly by the value creation from development projects and growing fund management platform. In fact, today they have announced a news to expand into US with GIC to acquire 8.1 billion USD US logistic portfolio, and this will grow the fund management platform assets by 61% to to 21.3 billion. For GLP, we like GLP for a strong balance sheet with the rich cash flow position, and we have an accumulated rating at 3.03. Last but not the least is Cinema Land. Cinema Land is an Indonesia property player. We like Cinema Land for its huge, the potential of unlocking value from his huge land bank and the superior profit margin, which indicates the potential growth in the real estate market in Indonesia. They have a very strong cash position of about 750 million and low gearing ratio, which enables them to actually take on more debts in future for future growth. We have a buy rating for Cinema Land with a target price of 0.96. That's all for today. Any questions?
Hi, morning. This is Richard speaking. There's a question for 800 Super. Question is, price has dropped about 10% since October, and is the target price still okay? Yes, target price at 68 cents. We have a 1-year horizon for that target price. So far, fundamental-wise, there's been no change for 800 Super since the last report. And last report, actually, there was an announcement where they have disposed one property for about 7 million, and they made a gain of, I think, 5 million plus. So that's actually almost 3 cents per share of gains. So currently, there's still no change in our target price for 800 Super. Thanks. Hi, there are several questions for REITs. Currently, we do not have coverage over REITs, but we'll be starting coverage on some REITs in the first quarter of next year, so stay tuned for that.
Hello. For the moment, we have not resumed the coverage for CRT, Cruises Retail Trust. However, for the Cruises Trust, we are still quite positive on it. Firstly, even with the management has been very diligent looking at the likely depreciation of the yen, but for that they have actually hedged the yen for the yen do hedging for the yen till end of 2015 next year. Thanks. Hello, there's actually a question that asks, will the expected rising interest rate cause property counters to have higher debt and equity ratio? Basically, for I think for this, a lot of developers have actually been anticipating on this also. So they have been very there's execute cautious on the taking on debt. For now, I think for now I think quite a number of players have actually re- refinancing on their on the debts currently because the interest to lock in the low interest rate for now. So I believe that with it will not actually cause us higher debt, but it will actually increase the interest expense in future. So this is one thing that the develop. I believe that will result in actually higher debt and equity ratio, and this is why a lot of the developers are actually executing cautious on this to monitor the debt ratio closely. Thanks.
Hi, there's a question. It says, so property developers are better than REITs. It actually depends on what is your investment objective. So as you know, the REITs actually, they are supposed to hold a stable portfolio of property, and your investment returns will actually come from their rental income. So you should not be expecting significant price upside from your investment in a REIT. You are more looking for yield from your distribution as a part owner of the portfolio of properties which they are collecting rental from their tenants. Whereas for a property developer, what they're doing is that they are buying land cheap and then building a building, be it a mall, residential unit, a hotel, and then after that they will sell it off. So the disadvantage, or rather the difference, I won't use the word disadvantage, but the difference from a REIT is that their revenue could be lumpy because there isn't a recurring revenue like the rental income that you get from a REIT. So as I first started saying, it just boils down to what is your investment objective. Do you want capital upside, or do you want a stable recurring income?
Hello. There's also another question saying, referring to the presentation, what are the top 3 indicators to look out for a turn in the real estate market? I think firstly, one is actually for property market, you actually look more on the demand and supply side. For now, the supply side, as we mentioned, for residential is upcoming. There's a lot of completion within the next 2 years or so, and this is why the government is actually also cutting back on the supply. So we believe moving forward, moving forward, maybe at end of my anticipation is end of next year, the price reverse. End of next year, we'll see some price stabilization and perhaps the price reversion then. Second is on the demand side. Demand usually for this, the cooling measure actually plays a huge part on it. For now, as we have seen just now in my presentation, the price has actually, the new prices for the residential housing has actually only dropped like 4%. I believe this is this is lower than expected than what the government have expected. So we believe that unless the government actually remove or lift the cooling measure, the demand will likely be tempered in this sense. But we have seen the drop in the resale for HDB, so my anticipation will be next and second half of next year there could be some relaxing of the cooling measure then. Lastly, also I believe also on the beside the policy and the supply, the interest rate could also affect the real estate market then.
Hello, Kenneth here. So there's a question on Valuetronics, and the question is, what about Valuetronics? Okay, let's look at it at two ways. Excuse me, I have a cough. Okay, one, the price now is about 38.5 cents per share right now. Actually, the price has been very stable. It has been consolidating in this area. I'd just like to say that actually, is it undervalued? In my opinion, it is still undervalued because right now, even though there is talk about the competition in the LED lighting segment, right, we do note that there is a stability this year, meaning there is downward pressure, but it is not going down as fast as what some other bearish reports have talked about. Don't forget, last quarter, right, the revenue for the CE section, right, CE segment actually stabilized and it increased slightly. Now, do we expect further competition? Yes, but as long as it doesn't decay so quickly, that will give time for the electronics to concentrate on their ICE segment. That being said, if you look at my quarterly report, I hypothetically modeled in a severe bear case where the CE segment dropped 20% revenue for the rest of the year, as in there's 2 quarters left the rest of the year. If that happens, that basically corresponds to a 10% drop in net profit. So if you look at my report, right, I gave negative 10% for this year and next year just to see what it would be like, and even based on 7 times PE, because of its big cash hoard, etc., right, we still think it's undervalued and worth at least the high 40 cents. Okay. Now, technically speaking, I'd just like to say it's really interesting because I'll say that potentially the 30 cents looks like a bottom, and right now we are consolidating into what looks like a triangle. So what I would say is, as long as the sentiment, the overall sentiment for the stock market, if it remains positive, for example, the US has been very positive with many sectors, especially finances, going to near highs and breakouts. As long as the general market sentiment is positive, right, I think the chance of there being a upside breakout is higher than downside breakout, especially since we think Valuetronics is still undervalued at this point.
Hello, there's actually a question that asked me, I know what is the time frame for the price target of OUE. My time frame for it will be actually end of next year, 2015. Thanks.
Excuse me, just want to add on a bit about Valuetronics, right? To give you a perspective on the share price. So even modeling a 10% drop in earnings this year, if you peg it to 7 times PE, which is very conservative because most EMS can go for 8 times PE, so just pegging it to 7 times PE earnings alone, that's already 40 cents. And then because, I think 40% of its market cap is all in net cash. So anything more than 40% is a bonus due to net cash. So we think that for these reasons, it's still undervalued. Okay, thank you.
Hi, just some general comments on the capital data center REIT IPO, which we do see quite some general number of questions on them. Right, basically, the capital data center REIT is mainly it will be a trust whereby they actually earn the rental by leasing out the data centers. So mainly one of the key investment merit of this why we may want to buy this REIT is mainly for its distribution yield, which is currently about the forecasted yield based on the IPO prospectus about 6.8%. So this is in our opinion is very attractive, as this is quite in line with other distribution yield that's offered by the industrial REITs, which are which are generally the kind of the highest among compared to all other REITs in Singapore, right? So this mainly the REIT is though it might be one of the attraction of why you might invest in this REIT, but do take note that its portfolio includes of data centers around in Singapore as well as other countries, but the data centers in Singapore will have is mainly on the shorter lease terms, and the lease are expected to expire within the next 11 years. So this is one risk that you might want to take note of. Whereas other data centers in other countries are typically many of them are actually on freehold, right? So this is where the attractive part of it, where they assured some continuing cash flow generation from these freehold data centers, right? So that's one risk that we would like to highlight, because the Singapore data center in Singapore do actually take quite a bulk of its data center portfolio, right? Right, but overall, we do think that this is still it has a very good growth, mainly because of the growth in data centers due to the cloud technology, as more companies are also consuming more data and also looking for more cloud storage, also due to the growth of e-commerce trends as well, right? Hi, there's a question on coverage of SingPost. Yes, we do have coverage. You can actually refer to our initiation report that's dated quite several months back, right? On it, if you look into poems. Thanks.
Hello. Sorry. There is a question. Will your target price for JLP be affected by the expected translation loss of rental income back to Sing dollars and the likely greater competition posted by the Alibaba logistics subsidiary in China? Firstly, for this the JLP, we have actually for the I am not too sure which the loss of income, the expected translation of loss of rental income back to Sing. For this, we have actually tried to project a higher exchange rate back to Sing. So we, at least for this, we have tried to take into consideration for this. For regarding the second part on will there be a likely greater competition posted by Alibaba logistics subsidiary in China? For this, actually Alibaba is also one of the top 10 within the top 10 customers for GLP. So I think the market is big enough for the two players at the moment. Thanks. Hello, there have been a number of questions on Capcom and Sam Marine on Ijon accordingly. A pity our oil and gas analyst Benjamin is not around at the moment. Perhaps you can drop an email to his email accordingly. Thanks.
Hi, this is Lin Xin, your macroeconomist on China. There are a few questions on regarding the A50 ETFs. We have seen that the A50 ETFs have been shooting up recently because mainly due to the this A50 mainly consists of financials counters, and for last week the financials has a the financials industries has actually shot up quite a lot due to the interest rate liberalization, as well as on the back of government's introduction on the insurance, deposit insurance. So although that the interest rate liberalization might compress the profit margin, but actually the deposit insurance actually safeguard. It is a signal that government trying to show that they won't let this too big to fail SOEs, banks, to have something similar to what happened back then during Lehman Brothers crisis. So investors are quite confident in this, in particular those big banks which are which actually are under the A50 index. So at the moment we are still quite optimistic on the A50 ETF. Yeah, I hope that answer your queries.
Hello, there's a question on UOL, but sorry to inform that we do not have any coverage on UOL at the moment, so we can't really comment on it. Thanks. Compared to UOE and Cinema Land, may I know which one is better in terms of fundamental value? From what I see, I give my vote to Cinema Lands. Thanks. That's all we have for you today. Thanks. Bye.